UK interest rate has increased by 50 basis points to 3.5%, the highest level since October 2008, thanks to the Bank of England. Governor Andrew Bailey, Ben Broadbent, John Cunliffe, Jonathan Haskell, Chief Economist Hugh Pill, and Dave Ramsden were the 6 members of the Monetary Policy Committee that voted in favour of a half-point rate increase. However, 3 members abstained. Silvana Tenrero and Swati Dhingra preferred to keep the bank rate at 3%. Thok Catherine L. Mann preferred to raise the bank rate by 0.75 points, to 3.75%. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Interest rates. Raising interest rates increases borrowing costs for individuals and businesses in an effort to combat double-digit inflation. According to the Office for National Statistics, the rate of inflation decreased to 10.7% from 11.1% last month, reversing October's 41-year high of 11.1%. Despite the fact that inflation last month decreased, it is still 5 times higher than the BOE's mandated target of 2%. As the bank keeps up its pressure on inflation, some borrowers may immediately see increases in their payments. It's likely to make life more difficult if your borrowing is connected to the base rate, but the impact on fixed-rate mortgages and savings is more convoluted, said Sarah Coles, senior personal finance analyst at Hargreaves Lansdowne. It's possible that base rates will rise as savings and mortgage rates decline. There's certainly no cold snap on the cards as interest rates are concerned with yet another hefty hike boosting the base rate to a 14-year high, said Mark von Grundherr, director of Benham & Reeves. Due to the fact that homeowners who use variable rate products will now immediately see a rise in their monthly mortgage payments, this will be as welcomed by homeowners as the traditional lump of coal on Christmas morning. This will be the last thing they need as Christmas approaches, with many households trying to heat their houses in these cold temperatures. What rate rise means for personal finance and mortgages. Britain's households are under even greater financial strain, according to Bestinvest's Alice Hain, a personal finance specialist. It may not be standard practice for a central bank to raise interest rates while the economy is on the verge of a recession, but the Bank of England is determined to bring double-digit inflation under control and closer to its target of 2%. With the BOE anticipating a sharp decline throughout the first quarter of 2023, inflation may have peaked after falling to 10.7% in the year to November from a 41-year high of 11.1% in October, she said. Higher interest rates will undoubtedly put greater strain on household budgets, especially for borrowers whose finances have already been severely damaged by the toxic combination of rising prices, declining real earnings, skyrocketing borrowing costs, and tax increases in April. But as the lender tries to sustain the economy through the recession, interest rates are likely to peak at around 4.5% next year. From there, they could start to decline. The personal financial misery is far from over for the time being, with inflation still high at 10.7% and households attempting to absorb the sharp increase in interest rates from 0.1% at the beginning of December last year to 3.5% now. This is especially true when you take into account the harm that a contracting economy, rising unemployment, and falling property prices can have. An interest rate of 3.5% may seem alarming to younger generations who have only borrowed money during the ultra-low rate era, but for those more acclimated to larger interest payments, the anticipated peak in rates only returns them to where rates were prior to the 2008 financial crisis. The people with tracker or regular variable rate mortgage contracts will suffer the most right away. According to MoneyFacts, a 0.5 percentage point increase in the bank rate above the current average SVR of 6.40% would increase total repayments by about £1,509 over the course of 2 years. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.